Hey, it's Jason Rogers here. And in this video, I want to talk to you about why professional firms, notably accounting and law firms, can bankrupt you when you're looking to do your first deal, and really what to watch out for when you're going from 0 to 1. In other words, you're making your first business acquisition using other people's money, and then how to think about using accounting and law firms as you scale from 1 to 2, 2 to 3, 3 to 4 deals up that chain, and when it does make sense to bring on professional firms, because there is a time and a place for professional firms, but I don't believe it's going from 0 to 1. And I want to dive into the math. So let's go to a screen share here, and I want to show you a few things. Okay, so here's what I want to do. I want to show you a couple of resources. I'm shamelessly using my website here. First thing I want to do is go to a monthly debt service calculator just to show you what your cost of capital is probably going to be for a first deal. I'm going to put in some rough numbers, but let's say you do a deal that's a little over $1.5 million. I'll use 1.5 million. The loan's going to amortize over 10 years. That's pretty standard. Interest rates are fairly high right now. I'm going to go at 11%. And then here you see what the calculation is for that. You basically have a loan cost of about 20,000 a month, 20 and change. Okay, so from here, I basically want to, and here's the yearly payment, 247,000, right? You can see that right here. So now what I want to do is go to this extra resource and go to my DSCR calculator, debt service coverage ratio, and I'm going to say it's at, $500,000 in annualized net income. Our debt service was 247,000. And this is an example, but this is a very realistic example for a first deal, right? 500,000 in earnings, in other words, net operating income, or EBIT, earnings before interest and taxes. Okay, so 500,000 in earnings, about 250,000 in debt service costs. You essentially have a 202% DSCR, which is workable. Now, why am I talking about all this math, and how does this tie in, to you working with professional firms? Well, because I want you to think about this on a monthly basis. I'm going to, just divide these numbers by 10. Obviously, there's 12 months in a year, but let's say monthly you have about 50,000 in free cash flow, and you have, 24/7 in monthly debt. So again, still the same DSCR, but this really puts things into context on a monthly basis, right? You have $50,000, a month in earnings before your debt, which is about 25,000 a month. And now I want you to think about professional fees, professional firms. And I'm going to switch over so I can look right at you while we talk about the real punchline here, because this is the key. Okay, so here's really the punchline with accounting firms and law firms and why they can get you in so much trouble when you do your first deal. Now, I'm going to assume for a second that the first deal you look at and take seriously, you actually close. I'll talk in a minute why, if you don't close the first deal that you use the accounting and the law firms for, why it can get really painful for you. I'll talk in a minute why it can get really painful for you if your first deal doesn't go through the first deal that you use the accounting and law firms. But let's just assume for a minute that the first deal that you pull in the accounting firm and you pull in the law firm goes through, and it's the very numbers we just showed there, where there's 50,000 a month in earnings before debt, there's 25,000 a month in debt, which means truly there's $25,000 a month in free cash flow. Okay, well, from personal experience, I can tell you that an accounting firm will easily rack up $20,000 to $30,000 in fees to do a first deal, and a law firm can easily rack up $50,000 to $100,000 in fees. Now, let's just use blanket numbers because we can't be precise. Every deal is going to be a bit different, but let's just say you rack up $100,000 in professional fees. Okay, $100,000 in professional fees. Well, think about the numbers we just looked at for a reasonable first deal. You have 50,000 in earnings before 25,000 in debt, which means really you have $25,000 in free cash flow. Okay, $25,000 a month in free cash flow, and you have $100,000 in professional fees. My friend, you literally just burned up a third of your free cash flow for the entire year on professional fees. Now you may say, oh, well, that's not that big of a deal if I got the deal done. Well, first of all, that's assuming everything goes okay. Sometimes when you try to stabilize a business post-close, things actually get bumpy before they get smooth. So you're assuming for a minute that you're able to consistently hold earnings at the 50,000 a month with 25,000 in free cash flow, that $100,000 in fees, you're going to be literally dumping every dollar of free cash flow to those fees to pay them off over 4 months. And that's assuming they don't tack on any interest. And that's also assuming that your deal operates as expected. If it operates less than expected, then it may take you 6 months or 8 months to pay off those fees. And it could be even worse than that. Okay, you shouldn't have 4 to 8+ months of your annualized free cash flow going to professional fees. That's just way too much. And here's the problem too. Before we talk about what happens if you don't do your first deal successfully, and I mean, it gets way worse. So stick to this video to really understand the severity of what the situation really is. But I mean, moreover, when you look to do a second deal, you know what a bank's going to ask for? I know from experience. They're going to look for your they're going to look through your bank statements, your tax returns, your P&Ls, your balance sheets. And when they look through those financial documents, you know what they're going to see every single month? You making 5, 10, 15, 20, 25, $30,000 a month payments to accounting firms and law firms. Well, you know what that means? It means you're not banking cash. It means you're not showing net income. It essentially means you're not cash flow positive. You're breaking even or you're barely cash flow positive because most of your money is going to professional fees, which means in turn, the lender is going to look at you and your new company and say, your company is not ready to take on more debt because you're barely servicing what you've got. You're barely handling your existing debt load and you're barely handling your existing expenses. Why should you take on more debt? Your loan is rejected. And that is something that can occur. It's absolutely something that can occur because lenders will look at you honestly, and they don't want a story. Anytime you have to explain yourself to a lender, you've already lost 9 times out of 10. Okay, so, it's because we used a really expensive law firm and we used a really expensive accounting firm and we have to pay them back. Well, they're going to say, well, you haven't paid them back yet. Or, your tax returns finalized for that given financial year. And instead of showing, $200,000 of free cash flow, you're only showing, $100,000 of free cash flow. Well, you may not hit the DSCR marker that you need to do that next deal based on your existing year's tax returns. So the ramifications associated with paying 6 figures in professional fees when you're getting started are a much bigger deal than people realize. But it gets even worse than that. Okay, one of the things that a lot of the people that talk to me on the internet who tell me, they study other people online and, you got to use professional firms, you got to use accounting firms and law firms because so-and-so said so, whatever the heck, and they'll say things like, oh, well, Jason, you don't understand. You can roll the fees. You can delay the payment. You can do a success fee basis. I know the phrases, a contingency basis, and they have all these buzzwords, right? Great. Well, what happens when you find a deal, you think it's a winner, you get the accounting firm involved, you get the law firm involved, they rack up 50,000 in fees, and then the deal falls through and you don't close? Then what happens? Well, the smart people on the internet, will tell you, oh, well, you just roll the fees into the next deal. Okay, great. So let's just be sober about this. That means now you have $50,000 of unpaid legal and accounting fees, and now you're going to go use these same firms to do another deal or try to do another deal. Let's say this time the deal still doesn't get done, and they rack up another $75,000 in fees. Now you have $125,000 in fees, and you literally don't have any revenue. You think once you have $125,000 in accounting and legal fees that those accounting and law firms are still going to be joyously jumping to work for you? At some point, it gets pretty awkward and people get involved and they shut down your account. That's what happens when you don't pay vendors, okay? They shut you down. You can't just roll the fees for the first $3 million and expect to get away with it. So, the example I gave you before this about how much it can eat into free cash flow, that's assuming your deal goes through. I had an individual who was working with me about a year and a half ago. And, somebody on the internet, you probably know his name, said, use accounting firms, use professional firms, use legal firms from day one. And I said, I don't recommend it. And he said, yeah, but this other guy does. So I'm going to follow his advice. And I said, it's your life. Go get him. He racked up $30,000 in fees. His deal didn't go through. And he basically just got squeezed where, he got burdened with these fees and he ultimately had to come out of pocket and start paying them. And it screwed up his life, basically. It screwed up his life. And there was so much pressure that he just wasn't able to proceed. Now, could there have been ways he could have navigated around that? Probably. But, you put yourself in a pickle and it was unnecessary. When the obvious counter to all of this is, why don't you just give a couple of points of equity to an accountant, somebody who has a lot of experience with auditing financials and understanding how to read financial documents? Give a couple of points of equity to an M&A lawyer who's willing to do the contract work and the negotiation on your behalf. You gave away maybe 5 or 6 points of equity. You're still holding, after your industry expert, your accountant, your lawyer, you're still holding the better part of 90 to 95% of the equity of the deal. and you're not out of pocket a nickel. I mean, it's so much better. I don't know how else to say it. Now, of course, yes, there's a time and a place for accounting firms and law firms, or really an accounting firm and a law firm, most likely. There's a time and a place. We have a large accounting firm that we work with now. We have worked with a large law firm at this point now because I've done multiple deals. And so you can afford those things once you get larger. But even still to this day, I'm skeptical of those kinds of firms. And I don't use them willy-nilly. You have to manage them very closely. I mean, I remember back when I was getting started before I did my first deal, I got a $30,000 invoice sent to my parents' home because I literally didn't have a place to live back then. I was so broke before I got started. $30,000 invoice from a large law firm, an international law firm, like the ones that certain gurus recommend that you work with. Okay. $30,000 invoice for work that hadn't even been done yet. But they wanted to charge me $30,000 to form an entity and to write an operating agreement. Literally, they wanted to charge me $30,000 for a stack of paper that showed me, oh, yeah, you have a business now, sir. $30,000. Now, look, when you are an 8-figure or a 9-figure business, $30,000 is a drop in the bucket. But when you're getting started, $30,000 is a lot of capital. And so you have to be smart with cash, especially we're now in a higher interest rate environment where you can't borrow money, business capital at, very low percentages. The cost of capital has gone up, my friend. So be smart. And when it comes to going from 0 to 1, follow a framework that works in the 2020s. Okay, this is a shameless plug. If you want to buy your first business, a 7-figure business in the 2020s, consider working with me or at least following my stuff closely because I've actually done it in the last few years. I'm not one of these guys that did it 30 or 40 years ago. And I'm not somebody that is trying to sell a dream that's bigger than it needs to be. Look, there's tons of money to be made with business acquisitions, but don't get it twisted. You can bankrupt yourself so damned quickly if you don't know what you're doing. That's just the truth. Okay? Hopefully this video has helped you understand the true risks associated with professional firms. There's a great place for them. Let me be clear. Okay? An accounting firm can do a tremendous amount of work for you in diligence. They can do quality of earnings where they basically audit financials of acquisition targets you're looking at. They can help you with your taxes. They can help you save taxes. They can help you do all kinds of things. Same with law firms. They can help you negotiate. They can help you, protect yourself from liabilities with deals you're doing. Okay, but when you're doing a simple 2, 3, even $1.5 million deal, okay, these deals are pretty simple. You don't need Deloitte and Skadden doing your accounting and legal work respectively. Okay, these deals are not that complicated. Save yourself $150,000 in fees and bank that free cash flow to the bank so you actually build up your balance sheet with cash, demonstrate to lenders and to investors that you are profitable so that you have the opportunity to keep expanding. Because that's really what we're all after, right? It's not about doing one deal. Okay, you don't build wealth by making one business acquisition. You build wealth by making multiple business acquisitions and by growing your businesses over time. That's how wealth is created. Hopefully this has helped. If it has, go to jasonpaulrogers.com for more, subscribe, and I'll talk to you in the next one.